Hi, welcome back. Today we're looking at something that's been catching the attention of investors all across the country. And honestly, it's a story that deserves your full attention. Silver has been on a remarkable run, pushing up toward the $66 mark, and a growing number of analysts are now talking about $70 as the next stop. But here's what makes this moment really interesting. Silver isn't just rising on its own. It's actually outperforming gold, and that's a shift worth understanding, because when silver starts moving faster than gold, it usually tells us something important about where the broader economy is heading. Now, before we go further, let's talk about why this matters to you, even if you've never bought a single ounce of silver in your life. Precious metals don't move in a vacuum. When silver and gold start behaving differently from each other, it's often a signal about inflation, about interest rates, and about how confident people are in the value of paper money. So whether you're someone who's curious about investing, someone who already holds some metals, or just someone trying to understand what's happening with prices at the grocery store and the gas pump, this story connects to your everyday financial life more than you might think. Let's start with the basics of what's actually happening right now. Silver has surged toward the $66 level, and it's done so at a pace that has left gold behind. For a long time, gold has been the metal that gets all the headlines. It's the one central banks buy, the one people think of first when they hear the words safe haven. Silver has usually played a supporting role. But over the last stretch of trading, silver has quietly become the star of the show, climbing at a faster percentage rate than gold. And that's a pattern that doesn't happen very often. Here's what this means in practical terms. When silver outperforms gold, traders and analysts often describe it using something called the gold-to-silver ratio. Think of it this way. If gold is trading at a certain price, and you divide that by the price of silver, you get a number that tells you how many ounces of silver it would take to equal the value of 1 ounce of gold. Historically, that ratio has swung widely, sometimes climbing above 90, and other times falling closer to 30. When the ratio is high, it often means silver is cheap compared to gold. When the ratio starts falling quickly, like it has recently, it usually means silver is catching up, and sometimes catching up fast. To put that ratio in real numbers for a moment, think about a period when gold was trading somewhere around 90 times the price of silver. That would mean it took 90 ounces of silver to buy just 1 ounce of gold. Many longtime watchers of the metals market consider a ratio that high to be a sign that silver has been left behind and is due for a period of stronger performance. As that ratio compresses, moving down toward the 50s, or even lower, it reflects exactly what we're seeing now. Silver gaining ground at a faster pace than gold, even when both metals are technically moving in the same direction. This is why some investors pay close attention to that ratio as a kind of internal compass, not to time the market perfectly, but to understand which of the two metals might have more room to move given the current environment. Now, let's talk about why this catch-up is happening, because there are several forces working together here, and understanding them helps you see the bigger picture instead of just watching a number go up on a screen. The first big piece of this puzzle is the Federal Reserve. Interest rate policy has an enormous influence on precious metals, and here's why. Gold and silver don't pay interest or dividends, so when interest rates are high, holding cash or bonds becomes more attractive because you're earning a return just by parking your money there. But when the Fed signals that it's ready to cut rates, or even just slow down its pace of tightening, that changes the math. Suddenly, holding metals doesn't feel like you're missing out on much, because the alternative, sitting in cash, isn't paying as well either. Recent signals from the Federal Reserve have leaned toward a more cautious, patient approach to interest rates, and markets have picked up on that. When investors sense that borrowing costs might ease and that the era of aggressive rate hikes could be behind us, Money often starts flowing toward assets like silver and gold. And silver, because it's a smaller market than gold, tends to react more sharply to these shifts. Think about it this way. If gold is like a large, calm lake, silver is more like a smaller pond. It doesn't take as much water to make waves in a smaller pond, and that's part of why silver's price swings, both up and down, tend to be more dramatic than gold's. The second major factor driving this move is inflation data. When inflation numbers come in hotter than expected, it raises concerns that the value of the dollar is being eroded over time. Precious metals have historically been seen as a way to preserve purchasing power during periods when prices for everyday goods are climbing. Now, this is important because inflation doesn't just affect investors, it affects everyone. It shows up in the cost of groceries, in rent, in the price of a used car. When people start feeling that their money doesn't stretch as far as it used to, some of them look for ways to protect their savings. And metals like silver and gold have historically been part of that conversation. There's also a geopolitical layer to this story that we can't ignore. Tensions in different parts of the world, whether it's trade disputes, regional conflicts, or uncertainty around global supply chains, tend to push investors toward assets that aren't tied to any single government or currency. Silver and gold have played this role for centuries. They don't belong to any one country. They can't be printed or created out of thin air the way currency can. So when the news cycle feels uncertain, and when headlines about international tensions keep appearing, it's natural for some investors to look at metals as a kind of ballast, something steady to hold onto when other parts of the financial world feel shaky. But silver has something gold doesn't have quite as much of, and that's industrial demand. This is a piece of the puzzle that often gets overlooked. Silver isn't just a shiny metal that sits in a vault. It's used in solar panels, in electronics, in electric vehicles, and in a whole range of industrial applications that are only growing as technology advances. Gold is mostly bought for jewelry and as a store of value. Silver is bought for those reasons too, but it's also consumed, physically used up in manufacturing processes around the world. That means silver demand comes from two different directions at once. Investors want it because it can protect against inflation and economic uncertainty, and manufacturers need it because modern technology genuinely depends on it. When both of these forces pull in the same direction at the same time, it can create real supply tightness, and tight supply paired with strong demand is often a recipe for higher prices. It also helps to understand that silver mining doesn't work quite the way many people assume. Most silver isn't mined on its own. A large portion of global silver supply actually comes as a byproduct of mining for other metals like copper, lead, and zinc. That means mining companies can't simply decide to produce more silver just because the price is rising. Production is tied to decisions made about entirely different metals, which limits how quickly new supply can enter the market even during a period of strong demand. This structural limitation is part of why sudden increases in demand, whether from investors or from industries like solar manufacturing, can have an outsized effect on price. The supply side of the equation simply can't respond as quickly as demand can shift. Let's break this down a little further with a simple mental framework you can use to think about this whole situation. Imagine silver sitting at the intersection of two roads. One road represents its role as a monetary metal, something people buy when they're worried about inflation or currency stability, similar to gold. The other road represents its role as an industrial material, something factories and manufacturers need, regardless of what's happening in financial markets. Most of the time, these two roads don't get heavy traffic at the same moment, but right now, both roads are busy. Investors are turning to silver as a hedge, and industries are consuming it at a growing pace for solar energy and technology. When both of these lanes are congested at once, it puts extra pressure on price, because supply simply can't expand overnight to meet two sources of demand at the same time. Now, before we go any further, if you're finding this breakdown helpful, Take a second to hit that subscribe button and give this video a like. It genuinely helps this channel keep producing clear, honest breakdowns like this one without any hype attached. All right, let's keep going. So what about the idea of silver reaching $70? It's worth being clear here that no one, no analyst, no channel, no expert can predict the future with certainty. What we can do is look at the forces currently in motion and understand what would need to happen for that kind of move to continue. If the Federal Reserve continues down a path of rate cuts or even just maintains a dovish tone, that removes one of the headwinds that typically weighs on metals. If inflation data continues to run above target, that could keep the case for silver as a protective asset intact. And if industrial demand from solar and electric vehicle production keeps climbing the way it has in recent years, that adds another layer of support underneath the price. At the same time, it's important to acknowledge the other side of this story because a responsible breakdown always looks at both possibilities. Silver is known for being volatile. It can rise quickly, but it can also correct just as fast, sometimes more so than gold. If the Federal Reserve were to surprise markets with a more aggressive stance, or if inflation data came in cooler than expected, some of the momentum currently pushing silver higher could ease. Geopolitical tensions can also resolve faster than expected, and when that happens, some of the safe haven demand that's been supporting metals can fade. None of this means the current trend is wrong, but it does mean that markets rarely move in a straight line, and pullbacks along the way are a normal part of how these cycles usually unfold. There's another angle worth mentioning here, and that's the psychology of the market itself. When a metal like silver starts making headlines for outperforming gold, it tends to attract more attention from everyday investors who might not have been paying attention before. That new attention can bring in additional buying, which can push prices higher in the short term. This is sometimes called momentum, where rising prices themselves become part of the reason prices keep rising, at least for a while. It's a natural part of how markets work, but it's also worth understanding because momentum-driven moves can sometimes run ahead of the underlying fundamentals, and eventually, price tends to find its balance again. So how does all of this connect back to your everyday financial life? Even if you'd never own a single coin or bar of silver, the forces we've talked about today, Federal Reserve policy, inflation, and global uncertainty, are the same forces shaping mortgage rates, savings account yields, the cost of borrowing for a car or a home, and the overall direction of the economy you live in every day. Understanding why silver is moving the way it is gives you a window into these larger economic currents. It's not just about a shiny metal going up in price. It's about what that price movement is telling us regarding inflation expectations, interest rate direction, and how investors around the world are feeling about the stability of paper currencies right now. It's also worth remembering that precious metals, like any asset, come with risk. Prices can be volatile. Past performance doesn't guarantee future results, and decisions about your own savings and investments should always take into account your personal financial situation, your goals, and your comfort with risk. This video is meant to help you understand what's happening and why, not to tell you what to do with your own money. That decision and the responsibility that comes with it always belongs to you, and it's worth talking to a qualified financial professional if you're considering any changes to your own portfolio. Let's bring this all together. Silver has been outperforming gold, climbing towards $66, with some voices in the market pointing towards $70 as a potential next level. This move is being shaped by a combination of factors working together at the same time: a Federal Reserve that appears to be leaning toward a more patient approach on interest rates, inflation data that continues to raise questions about the value of the dollar, ongoing geopolitical uncertainty that pushes some investors toward assets outside the traditional financial system, and a unique industrial demand story that gold simply doesn't share in the same way. The gold to silver ratio falling reflects silver catching up after years of lagging behind, and that catch-up has been swift. Whether this trend continues toward $70 or whether it takes a pause along the way will depend on how these forces evolve in the months ahead. What we do know is that silver currently sits at a genuinely interesting crossroads, pulled by both monetary demand and industrial necessity in a way that few assets experience at the same time. That combination is part of what makes this particular chapter of the silver story worth paying attention to. Thank you for spending this time with me today. If this breakdown helped you understand what's really going on with silver and gold right now, consider subscribing so you don't miss the next one, because we'll keep tracking these developments as they unfold. Take care, stay informed, and I'll see you in the next video.